Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about FLEX Limited quarterly report. FLEX Limited offers a wide range of businesses and services across various industries. In the data center, communications, enterprise, consumer, automotive, industrial, healthcare, and power sectors, the company provides technology innovation, supply chain, and manufacturing solutions. The company operates through two segments: FLEX Agility Solutions, FAS, and FLEX Reliability Solutions, FRS. FAS offers flexible supply and manufacturing systems for communications, enterprise and cloud solutions, lifestyle solutions including appliances and consumer devices. On the other hand, FRS provides complex ramps with specialized production models and critical environments for industrial, automotive, and health solutions. In addition to these products, FLEX Limited also offers various services such as design and engineering, supply chain management, manufacturing, logistics, and value-added fulfillment services. These services include product development, systems integration, procurement, logistics, warehousing, vendor-managed inventory, omnichannel fulfillment, kitting, configuration, and postponement. Overall, FLEX Limited's diverse range of businesses and services enables it to cater to the needs of various industries across different regions, including the Americas, Asia, and Europe. FLEX Limited's stock price has experienced a significant surge in the past year, exceeding 48.24%. The primary drivers of this increase are strong financial performance, an optimistic outlook, and strategic advancements in high-growth markets. One key factor contributing to FLEX's success is its robust financial results and upbeat guidance. In February 2026, the company reported record-breaking earnings, surpassing Wall Street's expectations with net sales of $7.1 billion and adjusted EPS of $0.87. This strong performance led management to raise full-year fiscal 2026 guidance for revenue, operating margin, and EPS. FLEX has also seen significant growth in its data center business, driven by demand for AI and data center infrastructure. The company's leadership in data center solutions has resonated with customers, enabling building at scale, speed, and quality demanded by the AI era. Additionally, strategic partnerships and product innovation have positively impacted investor sentiment. FLEX partnered with NVIDIA to co-develop modular AI data centers and introduced a new AI infrastructure platform that integrates power, cooling, compute, and services into a modular design. Furthermore, FLEX's commitment to returning value to shareholders has been demonstrated through its share repurchase program. The company reported strong operating cash flow, enabling significant share repurchases. These developments have contributed to a substantial increase in FLEX Limited's stock price, with the stock reaching a 52-week high of $72.22 on December 10, 2025, representing an approximate increase of 187.6% from its 52-week low within the past year. The primary drivers of revenue growth or decline can be identified through an analysis of various financial metrics. On the growth side, net sales have increased by $502 million in the 3-month period and $1,022 million in the 9-month period from 2024 to 2025. Contract liabilities, also known as deferred revenue, have grown significantly, increasing by $79 million from March 31, 2025 to December 31, 2025. The FLEX's point-in-time revenue has increased by 2% from 2024 to 2025, indicating a steady growth trend. Within the FAS segment, the CEC business has experienced an 8% growth in the 3-month period and 15% growth in the 9-month period. The industrial business within the FRS segment has seen high-teen percentage growth in the 3-month period. On the decline side, the overtime revenue of the FRS segment has decreased by 22% from 2024 to 2025. The automotive business has experienced a low single-digit percentage decrease in the 3-month period, while the consumer devices business has seen a percentage decrease due to lower demand. Additionally, a decrease in interest income is attributed to lower interest rates and lower average cash balances. Overall, these drivers indicate that revenue growth is driven by increases in net sales, contract liabilities, and certain segments within the FAS and FRS segments. Conversely, revenue decline is driven by decreases in overtime revenue of the FRS segment and the automotive business. Net income and profit margins show mixed results. The company's net income has shown mixed results over the past 3 months. For the quarter, net income decreased by 9% to $239 million compared to the previous year. However, for the 9-month period, net income increased by 2.3% to $630 million. Profit margins have also experienced changes. The gross profit margin increased by 6% to 9.6% for the quarter, and by 10% to 9.1% for the 9-month period. Similarly, operating income margin rose by 8% to 5.5% for the quarter, and by 11% to 4.9% for the 9-month period. The reasons behind these changes are varied. For the quarter, net income was negatively impacted by a charge to income tax expense. Additionally, asset impairments and inventory write-downs resulting from a missile strike also contributed to the decrease in net income. On the other hand, profit margins were positively affected by increased sales, which offset the negative impact of tariff costs paid and recoveries from customers. Overall, while net income has shown some fluctuations, profit margins have generally improved over the past 9 months. The company's ability to maintain profitability despite external challenges is a testament to its resilience and adaptability in a changing market. The company's financial performance indicates a strong ability to generate cash from its core operations. One key indicator of this is the significant amount of positive operating cash flow reported in various sections of the summary. According to page 40, the company generated $1.3 billion in cash provided by operating activities for the 9-month period ended December 31, 2025. This substantial figure suggests that the company's operations are producing a considerable amount of cash, which is essential for its financial health and growth. Furthermore, on page 8, it is stated that net cash provided by operating activities was $1,272 in 2025. Although this figure is lower than the one mentioned earlier, it still indicates a positive trend in the company's ability to generate cash from its core operations. In addition to these figures, page 20 highlights another important aspect of the company's financial performance: the sale of accounts receivable as a source of positive operating cash flow. This suggests that the company is effectively managing its working capital and generating cash through efficient management of its accounts receivable. Lastly, on page 12, it is reported that the company generated $129 million in operating cash flow by December 31, 2025. While this figure is lower than some of the other amounts mentioned earlier, it still contributes to the overall positive trend in the company's ability to generate cash from its core operations. In conclusion, based on these various indicators, it can be inferred that the company is indeed generating positive operating cash flow, which is a crucial aspect of its financial health and growth. The company's debt level has experienced significant changes over the past few years. Initially, long-term debt increased from $2,483 million to $3,760 million between 2 unspecified periods. However, when considering total debt, it rose from $3,692 million to $4,435 million during another time frame. Furthermore, a more recent snapshot shows that total debt has grown from $898 in 2028 to $4,453. In terms of interest expenses, the trend is less consistent. On one hand, there are instances where interest expense increased by small margins, such as plus 1% from $57 million to $58 million. Conversely, other periods saw more substantial growth, including a plus 183% jump from $57 million to $161 million. Additionally, interest expenses on debt obligations fluctuated between periods, with increases in both the 3-month and 9-month periods ended December 31, 2025. Management is signaling a cautious optimism about the company's outlook, despite acknowledging recent operating results that do not reflect future performance. They are focused on expanding into new markets and industries through their 2 operating segments, positioning the company to take advantage of long-term growth prospects in outsourcing advanced manufacturing capabilities. The company's strategy revolves around providing cost-competitive global supply chain solutions, which they believe will give them a competitive edge due to their extensive open innovation platform solutions, design and engineering services, and advanced supply chain management. However, they also expect to incur additional inefficiencies due to global economic conditions and the ongoing conflict in Ukraine. Management is confident that the company's financial position is strong enough to fund current and future commitments, with adequate liquidity to remain compliant with credit facility covenants over the next 12 months. Despite this, supply chain issues are expected to persist due to global economic conditions, which may pose a challenge for the company in the short term. Overall, management is emphasizing the need for adaptability and flexibility as they navigate changing customer needs and requirements, while also highlighting their competitive advantage and long-term growth prospects. The company has made several significant acquisitions in recent years. Two notable business acquisitions were made with contingent considerations. The first acquisition was valued at $2 million as of December 31, 2025, while the second was worth $5 million as of March 31, 2025. These acquisitions demonstrate the company's strategic efforts to expand its operations and capabilities. In terms of divestitures, there is no mention of any significant transactions in the extracted summaries. This suggests that the company has not engaged in any major asset sales or spin-offs in recent years. Concerns about inventory buildup and supply chain disruption are evident in recent data. Inventory levels have increased significantly, with raw materials rising by $355 million and finished goods increasing by $146 million over a 9-month period. Additionally, there is an inventory buildup of $15 million and a substantial increase of $0.5 billion. The situation is further complicated by supply chain disruptions caused by external factors. A missile strike on a facility in Ukraine resulted in inventory write-downs and the activation of contingency manufacturing plans. The facility suffered substantial physical damage and disrupted normal operations, leading to asset impairments and inventory write-downs. Furthermore, component shortages, semiconductor disruptions, transportation disruptions, and other supply chain constraints have been mentioned, exacerbating the issue. These concerns highlight the need for companies to reassess their inventory management strategies and supply chain resilience in light of these disruptions. That concludes the financial summary for FLEX Limited. Feel free to comment below, and I will be happy to answer them when possible.